Welcome back to another episode of Multifamily AP360. And today's our guest is Shane Thomas from Catalyst Equity Partners. Welcome, Shane.
Hey, Rama, thanks for having me.
Yeah,
Appreciate
thank
it.
you very much. Yeah, sure. And a little bit about Shane. Shane is a Canadian-born real estate entrepreneur and co-founder of Catalyst Equity Partners, a Texas-based privately held real estate investment firm founded in 2016. Catalyst focuses on the acquisition and management of large valued properties in high growth markets. Catalyst currently has 1900 plus units and assets under management valued at 300 million. Shane is also a co-founder of CEP Construction Services, a multi-family construction and rehab company. Shane leads the acquisitions, financing, asset management, and investor relations effort at Catalyst. Shane leverages his expertise in large-scale project management, analytics, and process improvements to ensure Catalyst process are best in class. So with that, Shane, you want to add anything to your background?
Yeah, no, thanks for that introduction, Rama. Appreciate it. Yeah, I think like Rama said, I mean, we formed the company about 8 years ago, and it's been a fun journey with ups and downs, that come with entrepreneurship. And yeah, my previous life, I'm a former CPA, management consultant, and a lot of those skills and traits kind of translated, to kind of help us grow. So yeah, so happy, I'm based in Houston, Texas right now, from Toronto, Canada, and lived in Chicago for several years. So yeah, that's kind of a great background.
Awesome. Thank you very much. So you have CPA background and also born and raised in Canada, right? So what makes you jump into real estate and also real estate and multifamily and also US markets?
Yeah, that's a great question. So I want to say since I was a kid in my teens, I've always kind of had the real estate bug, just kind of seeing, folks, in my surroundings, kind of investing in real estate when I was a kid and seeing that, at the end of the day, it's a long-term wealth creation vehicle. And so, from those, kind of early childhood memories, I've just said, I know that I wanted real estate to be a part of my investment portfolio. And so post, college, I started buying some single family, right? With, no intent to kind of grow to what we've grown to, but like plant some seeds, and mainly buy and hold homes, condos, single family in Toronto. And then, like you said, I'm a, educated, as a CPA, worked at a big four consulting firm. And, I quite frankly, I enjoyed what I did for a long period of time. And so that's kind of my real estate background. And then, I got an opportunity to move to Chicago in 2010 and then moved here, kind of head down work, for a good 5 years, but I was traveling a lot. I traveled every week pretty much consistently for 5 years. And that was great for my miles balances and, status and whatnot, but wasn't so great for just, kind of trying to build a family. I just got married and stuff like that. And so long story short, realized in 2015 that I had to kind of make a decision, and real estate had done well for me in Toronto, but I realized that, I want to basically get into real estate in the US. And so, long story short, started looking at, smaller multifamily. Being a finance guy, I wanted to get into more of the commercial space because I knew it was driven by income, not based on comparable sales like single family was, right? And so, I looked at, the capital I had at that time, and I said, okay, I'm going to go buy a 12 to 20 unit. And then long story short, I went down that endeavor, did a lot of work, and in many ways, kind of a blessing in disguise that it didn't work out. And then I stumbled across, what I would call large multifamily and then passive investing. And this is in 2015. And so I started investing as a passive investor in other people's deals in Dallas, right? So that's really how I got my feet wet in 2015. And then I started networking more in the space. I learned a lot from my passive investing experiences, right? Like the good things that sponsors were doing. And then I saw a lot of opportunities to improve, right? And given my background in finance consulting, project management, et cetera, I really saw a opportunity for me to say, hey, I think I could lead, these projects, right? And then, met my now business partner, Prashant, in Dallas. And yeah, we did our first deal, and, we've been, doing it for the last 7 to 8 years since then. So obviously, we can unpack what's happened in the journey, but that's kind of my foray from kind of, management consulting, CPA into real estate, and then in more specifically into commercial real estate, multifamily.
Awesome. Thank you very much. So with your background with CPA, so when you acquire any deals, what other things you look compared to other, investors?
I think, look, at the end of the day, having a CPA or accounting background is great to understand the fundamentals of business, right? From a back office perspective, right? We, trained to understand cash flows and P&Ls and balance sheet and whatnot, right? So I think that has helped a lot, especially on underwriting existing deals or new deals, and then B, being able to review and vet the financials that get kicked over, by the property management company, right? So that has been a definitely, and there's a lot of moving pieces in this business, right? I mean, we're talking, hundreds of thousands of dollars of cash moving in and out, lots of CapEx, these are multi-million-dollar buildings, right? And so, that really helped in the beginning. I was reviewing, every single deal, P&L, trial balance, everything. But as we, as you discuss a lot in your podcast, right? Like operations is critical here, right? So like, it's a very team oriented business, right? So like, we have my business, Prashant, very operations driven. We have outside, partners that, focus a lot more on the asset management and stuff like that, right? So I think everyone contributes to the team, but I think to answer your question, I think the CPA background just makes, I guess, me a little bit more dangerous in the sense that I could look at things, kind of with that hat on, just to say, okay, like, does this financials, are they complete? Are they accurate? What's missing, and what questions should we ask, right? So I encourage you, you don't have to be a CPA or whatnot, but I just encourage folks that if you're looking to either passively invest and or looking to buy your own deals, just ensure that you have somebody on your team that has those skills, right? And if you don't have those skills, right? I mean, even what we do right now is we've grown to a point where I can't look at every single trial balance, right? So we've got like a CFO, a fractional CFO that works for us and reviews all of our books from a completeness standpoint, right? So whatever, your situation is different, right? When we started, I was doing all the finance and accounting, right?
Yeah.
And now, but whatever your situation is, just have somebody on your team that has that subject matter expertise.
Awesome. So what's your business plan? What is the acquisition criteria? What markets you're focusing? What's your business plan and exit criteria for all your multifamily deals?
We've went up and down the food chain in terms of asset class, but our business plan high level has been, we want to buy value add deals, right? In, primarily Texas is where we focus. I mean, Texas is a huge market, right? Obviously, the demographic trends, point well to the Sun Belt, but Texas in particular with population and job, growth. We tend to stick to primary markets, right? So we're in greater Houston, greater Dallas, right? We try to stay away from what I would consider secondary and tertiary markets. And our thesis is that, yes, you could probably find a little bit more yield, but it comes at the cost of A, harder to manage, B, there's like not as many vendors that want to go out there and work on properties. And then most importantly, C, it's not as liquid as a market, right? And so those are the markets we focus on. We generally are 150 to 300 units. I mean, we've never bought anything above 300 units. We've never bought anything less than 125. We like that sweet spot. I know a lot of people think about 500 units, 1,000 units. I mean, we think you lose economies of scale after 300 units. So that's our general wheelhouse. We've, in our beginning of our career, we bought mostly C assets, 1960s, 1970s workforce housing. And then as cap rates started compressing, we started buying newer stuff. So we've got a few, what I call A- deals, they're suburban, garden style, stick built deals, 2004 construction, 2015 construction, first generation value add, and you don't have a lot of the functional obsolescence. And we did that because cap rates were becoming the same cap rates, And then now, I mean, so we're not opposed to going and buying older right now, but you have to be compensated for the risk that you're taking on. So yeah, that's pretty much our criteria. I mean, returns wise, I mean, I think, focus on market-based, kind of returns. We're looking at, 1.8 to 2x equity multiples on a 5-year hold, mid-teens IRR and, cash flow when we started, was a lot higher. We were looking at double-digit average cash on cash. And, as most people know, the last 2 years, interest rates have skyrocketed. And I think in general, I mean, we're looking at, mid single digits, 5 to 7% average cash on cash, we think is, what the market, wants right now.
Yeah, awesome. Thank you for sharing that. So you mentioned your buyback criteria 130 or like 150 to 300 units. So what is the reason behind that? Like, and the other point is behind 300 units, there is a challenge with economics of scale. So can you elaborate on that?
Yeah. So, I mean, obviously, I mean, maybe not obvious, but like when you buy a 20 unit, it's really hard to staff, right? Like you
Yeah,
can't get a full-time manager, right? So generally, 100 units is really where you get, in my opinion, the ability to hire two staff members, right? And the general rule of thumb in the industry is that for every 100 units, two people, one in, one out,
yeah,
right?
yeah,
But in general, right, based on talking to a lot of property management folks that have been in the business for a long time, 2 to 300 units is like the optimal, size. You could, manage it with, 6 to 7 people, right? B, once you get above 300 units, right? Like 400 or 500 units, you have to lease like 30 units a month. Like that's a lot. That's a lot of marketing, right? You're almost having these mini cities, right? Once you get to 400 or 500 units, you start losing some scale because if you're not marketing, if you're not getting leases, you start losing retention, right? And then the other thing is, honestly, once you get to 400 or 500 units, 600 units, the deal size becomes so big that it becomes less liquid, right? Because there's not a lot of buyers that can go buy 60, 70, $80 million deal.
yeah,
Okay.
yeah,
Whereas there's more buyers that can do 15, 20, 25, 30, right? So you
yeah,
lose your buyer pool shrinkens, which, when you're selling, you want as big a buyer pool as possible, right? And then B, when you run into challenges, right? Everyone looks at the upside, oh, bigger deal, more, you could probably make more money, etc. Right? But then you also got the downside effect, right? Like when you have a 50 or an $80 million loan, a 1% problem there is a bigger problem than a $15 million loan, right? And
yeah.
so I just think that there's just a lot more downside the bigger you go. So, not to say that we'll never do a 400 unit deal or something like that, but like we've generally been, 150 to 300 is kind of the sweet spot for us. Hopefully that answers your question.
Yeah, thank you for explaining that. So from capitalizing point of view, who will be your ideal, investors? What is your process?
Our investors are, high income earners, basically W-2, some business owners, but folks that, are looking, A, have disposable income, B, have the investor mindset, right? C, understand that, these are generally illiquid investments. They're long term, right? And so obviously, as your listeners know, there's several rules around being accredited and whatnot and the SEC. So we abide by all those rules and want to make sure that people understand that, hey, this is not, you're making this investment, but it's like any other investment, right? There are risks. And so we just want people to have the financial wherewithal to understand that. Right. And so yeah, I mean, that's really, kind of what we've done to date has been, on average, our minimums are usually 75,000, right? And yeah, our investors are pretty much based all over the North American continent, Canada and the US. And we've started talking to, some JV, partners, some private equity and whatnot, but we've not done a deal with a large check writer just yet.
And also you are best in class asset manage operators, right? So what kind of challenges you guys faced last 2, 3 years because of high interest rate or lot of supplies coming, inflation, all this stuff. So could you
Yeah.
elaborate on that? Yeah.
Yeah, that's been the talk of the industry, right? For,
Yeah.
the last couple of years. I think anybody that's in commercial real estate would likely understand that transaction volumes are down. Real estate is very much a interest rate, driven business, right? And when rates went from, next to nothing in terms of Fed funds, at, a quarter, point to 5.5, that had a lot of impact, right? And so, our challenges, fortunately, I would say for the most part, our deals, I mean, we're 95% occupied. across Houston and Dallas. We're focusing on retention. We're not pushing rents as significantly. There's a couple of deals where there's in place loss to lease where we're able to really drive rents. But for the most part, if you're already at market, we're not pushing rents. We're focusing on occupancy over rents. And so we've had a few deals that, where there's been a lot of supply, you've had to give concessions, right? But, from a top line perspective, we are, quite frankly, I mean, pretty pleased with where we're at, especially given the market. But on the bottom line perspective, things have been tough for two reasons. One, like you mentioned, inflation has really, made our expense growth a lot higher than our revenue growth, and it's across the board, right? Like materials, insurance, especially in places like Texas and Florida. I mean, in some cases, I started in the business 8 years ago, have 5x'd, our insurance premiums, taxes. That's a tricky one. They kind of go up and then you got to fight them down and stuff like that. So, but like in general, our expense load is up 10 to 15% per year the last 2 years, And even if we were able to kind of stomach that, the biggest challenge we have and most people have in this industry right now is that below the line debt service, right? And, a lot of deals were done with floating rate. And honestly, I think there's nothing wrong with floating rate debt if you've structured it correctly and you've got the right business plan, right? So I think, right now a lot of people are getting, unfortunately hurt, with whether it's capital calls or losing money because of some floating rate deals. But, I think it's being taken out of context, because there's, floating rates existed for, decades, it's not like a new product, but it exists. A bridge loan exists for a reason, to bridge you from A to B, and I think, in the 2021, 2022, that was taken out of context. And so, managing the debt has been, the debt service increases have been a challenge. Fortunately for all of our deals, we've been well capitalized. But, our runway isn't forever. Our runway was long, but, as the rates remain elevated, that is something that we're maneuvering and managing every day. So yeah, hopefully that answers your question.
Yeah, absolutely. Thank you. So, and also you guys are also doing in-house construction and also construction management, right? So
Yes.
would you share what is the reason behind it? What is the advantage with that?
So we brought construction in-house 3 years ago. And, we had done a couple deals, with us being kind of like managing the project. And we were smaller deals. We were doing deal by deal. But as we started to scale and we started buying bigger deals and multiple deals at the same time, we had to do 8 units at this property, 6 units here, right? And then it was just becoming, we're very dependent on our contractors, and, there's a lot of great contractors out there, but there's a lot of bad ones, And so when we have to move fast, especially when you've got bridge loans, we decided to bring it in-house to control the process, right? So we can control the sourcing, control the execution, right? So we did that for about our 1,200 units that we acquired since 2020. And then we started getting, folks to kind of ask us, hey, who do you use for X, Y, and Z? So we started offering as a third-party service as well. But I think at the end of the day, it enables us to control our execution and minimize our variables, right? Which has been very beneficial, especially for these, bridge loan deals where you, need to do these renovations by this time to be able to grow your NOI to have a takeout.
Yeah, definitely there is a lot of advantages, a lot of things you can control with that, right?
Yes, it's been a game changer for sure.
Yeah. So are you guys also doing in-house property management?
Not yet. We've got an asset manager, we've got an operations manager, we've hired folks internally to be able to manage the manager very well, right? We're, kind of, we do in-house management? Yes, there's pros and cons. We always, every quarter, discuss it. But at this stage that we're at right now, about 2,000 units, we think it's not strategic to do just yet. We get bigger, we'll revisit it. But right now, we've just done whatever we can on our side in the back office to make sure we manage the manager very well.
Yeah, sure. So what's your company's strategy for next 2 to 5 years?
That's a great question. And, we've obviously this last 18 months has been challenging, right? But since 2016, folks have always been saying, hey, it's the market's hot, this and that. And the 2016 to 2022 was there's COVID and whatnot, but like we've seen different cycles, right? Mini cycles. And the way I look at it is that a lot of people talk about, hey, I want if I had one more shot at 2008, or if I had, like that shot one more time, and quite frankly, I think we're here, right? But when you're in it, it's a lot easier said than done, right? Because there's a lot of fear in the market. Investors are, some of them have been hurt. Their interest rates are high. So it's very hard to do, right? But what we are committed is that we've done this for 8 years, 2,000 units. We've tried to hone our craft. We've made our fair share of mistakes, right? But I believe, that if you could get your hands on some good real estate, structure it properly to have long-term runway, I think right now is a great time to buy, right?
Yeah.
But but you got to structure it well, right?
Yeah.
Do I think we're gonna see gains like we did from 2010 to 2015? Probably not. The fundamentals are still strong, right? And then I see it right now. We offered on a couple, we've offered on, a dozen deals this year. And I mean, all the deals have, 10, 15, in some cases, 40 offers, right? And like I told you, our occupancies are 95%. We still have demand, right? It's not like 2008, 2009, where, occupancies dropped to, the mid 80s, right? And there was no lending, there was no equity, right? So yeah, so that's why I don't think like people are going to see like these outsized returns, but you're going to see returns that that we haven't seen in 10 years. And so yeah, I mean, there's going to be challenges, there's going to be some distress, right? Especially for operators that just can't hold on to the deals. But I don't see widespread distress coming. Could be wrong, but just based on what we're seeing right now, it's not widespread.
Yeah, got it. Thank you. So, would you share any of your best multifamily investing experience so far?
Yeah, I mean, we've had some wins, sold 2 deals, we refied a couple deals. I think, one of our best deals to date has been was a deal that, it's kind of what I call the textbook deal. Okay. We bought this in 2018. It's one of our first deals that we bought. Class C deal in a great location in Dallas, was very beat up. So we invested a lot of money into it. We bought it as a loan assumption at a fixed rate, and so it was already amortizing payment. We had a great delta between our cap rate and our interest rate was almost a 400 basis point delta. And so, we transformed that property, and then we did 100% plus cash out refi in year 3, almost to the day, like 3 years later. Like, that's why I say textbook, right? Did 100% cash out refi, lowered our interest rate, lowered our interest payment, and then we were pushing out cash flow on that deal pretty consistently. And then in year 5, right, almost to the day again, we sold the deal, right? So like, that's the way I call it textbook, right? We bought it, transformed it, refied it, had no money in the deal, sold it. So it ended up being I think it was like a 2.85 equity multiple over 5 years. It was like a 35% IRR on a 5-year hold, So, blew it out of the water, I think, and that was kind of a textbook deal, right? We financed it, assumption, fixed rate, refied it, fixed rate, sold it as an assumption, because the rate was low. So yeah, that one was one of the big wins for sure.
Awesome. So, would you also share any challenging experience?
Yeah, I mean, I think the other deal we sold, that was actually our first deal ever. We learned a lot of lessons on our first deal, and we ended up doing well on the deal. We had 25% annualized returns on the deal when it was all said and done, which, beat our projections and everyone was happy. But it was a bumpy ride. We bought this deal, in a market in Houston. Occupancy that was stated when we bought it was like 90% on the rent roll. We got in, it was 80%. We had to go through fired two property management companies within the first 6 months. You know, and this is like my first foray into multifamily. And, I'm thinking, man, what did I do here? Like, and so we fired two property management companies. We brought the occupancy down all the way to 60% because we had to re-tenant half the property. And then we ended up turning back and got the property to 94% stabilized, raised NOI, about 25% in 2 years. I mean, we had a little bit of cap rate compression, and then we were able to sell the deal in less than 2 years. And like I said, 25%, we had like a 1.5 equity multiple in less than 2 years.
Got it. Yeah.
And so, but through that, like I learned so many lessons, management lessons, boots on the ground, tenant profile lessons. We weren't even that well capitalized on that deal. Like our CapEx budget today, I would look at it as almost a joke, we were, so we didn't have to, we learned so much from that deal that we applied to every single deal afterwards, and so that's why we've always had overcapitalized every single deal, but yeah, so that one, but I think it goes down to fundamentally, we bought that deal at a good basis.
Yeah.
We also had, a good loan. And, if you have time and you buy right, and you manage well, it's generally forgiving, right? Like what you don't want to be is a forced seller, or you've got debt that you can't stomach, right? And though that's when you get in trouble in real estate.
So any habits that are helping you to be successful?
I'm a very, I guess, pretty disciplined. I'm very consistent. I try to wake up early every day, exercise, and then, try to accomplish. I used to have huge to-do lists, but like now it's really, I want to accomplish 3 things today, right? And try to focus on the stuff that's actually going to move the needle. We talk about revenue producing activities versus not. And, just being, very accountable to what we set out to do, right? And we try not to, like there's a lot of shiny objects, especially when the market is tough right now. There's a lot of shiny objects. And so, we try to focus and hone on our craft, and now we've got to the stage where we've done this for 8 years, and I think, we've learned a lot. And so we're starting to look at different, things, but like we've never just jumped from thing to thing to thing, I think that's where people, you don't become a professional baseball player by playing 10 different sports, or a professional golfer, like you just got to be consistent. And look, there's times when strategies have to change and pivot, but I think consistency and being resourceful have been, the two habits that, or skills, I should say, that have kind of got us this far.
Yeah, that's very powerful stuff. Thank you. Any one personal learning that impacted your life?
I think when you're, like I want to say type A, or just, when you're a really motivated person, and, like you're, trying to, achieve, and which a lot of us are. And if you're an entrepreneur, you're trying to achieve, it's easy to kind of go at it alone, right? Because, I just like, hey, a lot of stuff when you're younger, school and stuff, hey, you're doing the test alone. You got to do it, everything, you're kind of competing. I think, being able to partner, right, and ask for help, right, seek out, whether it's mentors, peer buddies, whatnot. I mean, look, this is entrepreneurship is, as great as it looks on social media. I mean, it's lonely, it's challenging, you've got sleepless nights, and sharing that and asking for help, I think, is one of the biggest things that I've learned, because I used to be like, has to be perfect, do it myself. But yeah, I think expanding that team, as cliche as it sounds, I mean, is one of the most important things I've learned.
Awesome. Thank you. So any books that impacted your life?
Oh yeah, lots of books. But I would say one that stands out is Who Not How by Dan Sullivan. I've been a member for several years in that. And so that really, it is, when you think about the concept, it's very simple. I think it applies to not just business, to everything in your life. So we are a Who Not How family. So that's been a very life-changing, kind of mindset changing book.
Yeah, definitely powerful concept. So how can listeners can connect with you, Shane?
Yeah, happy to chat with any of your listeners. I mean, you could email me at Shane@catequity, CAT equity.com. I'm active on LinkedIn, so you could catch me at, find me on LinkedIn. And you can also visit our website at www.catequity.com.
Awesome. And thank you very much, Shane. Thank you for sharing your journey and also current markets challenges and also your best and challenging experiences plus your personal habits. Thank you very much.
Yeah, no, thanks for the opportunity, Rama, and kudos to you for a great podcast.
Thank you.